Okay, Module 5. This is the last section of the business plan that we're going to go through in the Developing Your Business Plan, BA 121A. It's been great spending the last couple weeks with you, and hopefully you've taken some things out of this that will allow you to better write a business plan and better plan for your future as an entrepreneur. Okay, so let's start. With the familiar view of the sections of the business plan. We talked about everything. We're going to briefly talk about the appendix section towards the end, but right now we're going to talk about the kinds of reports that your investors, that you should be putting together and your investors are wanting to see. Okay, I feel the need that I should throw up the disclaimer again. This is really general section, and when it's getting to this financial section, I need you to realize that I am not a financial analyst, and that if you need help with your specific finances and your cash flow and your projections of sales and things, that you should find and seek out professional counsel. All right, let's kind of dive into some of the specifics of what an investor is going to want and why you actually need to have a financial section in your business plan. Investors want to know how you're going to grow your business, how you're going to make a profit, and how are you going to turn it from a startup into a ongoing business. And it will give you an opportunity to understand how you operate. These are sections of these that actually get to the bottom line. This is the true bottom line. A lot of the sections we've been talking about, product and marketing and that sort of pricing and that sort of thing, get you to this bottom line, and that's where you're going to show it. The important thing is that there's a basic rule of thumb in the financing section, is that you really need to be realistic when it comes to this. You just need to make sure that you're going to break even. Don't put your head in the sky, in the clouds, and think that it's going to be something that is realistically not possible, because your investors will look at it and say that's not possible, and go back and rethink it. So start from the beginning and do it right the first time, so that you have a better idea of how you're going to turn your idea into a profitable business. So what do you include in the financial section of it? You include a profit and loss projections. They can be and should be at a 1-year intervals, and then 2, 4, and 5-year projections out there. So you're going to do a profit and loss. You're going to project out sales and expenses, both fixed and variable expenses. So fixed are things that stay, like rent stays the same all the time. Variable would be the cost of goods. Those kinds of things are going to change. So you need to kind of know what's the potential changes in those costs are going to be. They're also going to ask you for a break-even analysis, and they're going to say, at this volume, what's it going to take to break even? At this volume and at this price, what's it going to take to break even? So those are the kinds of things that they're going to want to see. That gives you, makes you think about it, think about the realistic potential of making money with this new idea that you have. The next thing they're going to want to know and want to see is a balance sheet. It's the assets that the business owns versus the liabilities of what the business owes, right? So if you, for instance, have a lot of equipment that you've gathered over time and you want to turn that into a business and making things, if you're a carpenter and you have a lot of equipment and a hobby of making fancy cutting boards, then that turn that business, and those are the assets that you have, all those tools, all those machines that you've got to, that's what the business owns, right? The business liabilities is what you owe. So if you, for instance, have a bills for the wood of the cutting boards, or the rent for the warehouse that you're storing things in, employees, that sort of thing. So you'll want to make sure that all of those things and a balance sheet, those assets have to equal the liabilities and owner's equity. I'll show you some examples of it. You also want to show a cash flow. How is your how are you going to make money, and where's the cash going to come, so that the investors are going to want to know that you can pay your bills. So this cash flow statement shows where that cash is from. It could be maybe coming from the investors. It could be coming from loans. It could be coming from sales. But they need to know where that cash is going to come from so that you know that you can pay your bills. And then those projected accounts payables and accounts receivables to match that cash flow. The thing is that you just need to be realistic in this. So you want to make sure that you can pay those bills. Okay, so for the next couple slides, I'm going to go through some examples of what some of the documents are that you might look at including in your business plan. This is an example of a sales forecast. So you can see that it is going for the first year. So they started in January. This looks like it's an app of some kind. And they've said that they're going to have 500 downloads of the game in January, and that by the time they get to December, they'll have 4,400 downloads per month. So, and you can see how it's talking about sponsorships. They're going to get some, they're going to start selling some sponsorships to the game. And then later that's the cost of the download. It's going to cost $2 to download. Game sponsorships are going to be at $5,000. And then what their sales are going to be, unit costs, and that sort of thing. So you can see how it's a progression over time. You're going to want to do this by month for the first year, and then perhaps even the second year, and then when it gets into the third, fourth, fifth year, then you'll just do it by year. You could do it by quarter, but in the first year, an investor is going to want to see it on a month-to-month basis because they want to see that progression of growth and what it's going to cost to make that money. This is again the second, so another forecasting. So you've got that first year that you're breaking it down into months, and then you can do a much bigger picture of the first year I'm going to do this much, the second year I'm going to do this much, the third year I'm going to do this much, and you can see that progression and growth there too. Hopefully this is very realistic. That doesn't necessarily need to be $20,000 more each, or $400,000 more each year, but if they have the reasoning to back this up, then there should be no question as to whether or not they can make these forecasts. This is just a graphic way of saying the same thing. So sales, they're going to want to see the real dollars, but you can include certain graphs and visuals to help tell the story. This is an example of an expense report. It's a detailed expense report, and you can see that it's the first year because it's month by month. It talks to the income that they have projected throughout the entire year. You can see that in January they're not expecting any income whatsoever, but they do have expenses. They have $7,600 worth of expenses. So at the very bottom, there's a negative loss. There's a loss. So a negative 7631 because they have no income. Then as they start to make some money, and create some sales in February and on, then their expenses are against that income, right? So they are not projecting to make money until August of the first year, which is absolutely fine depending on the business because there is an expected loss of income in startup. There are expenses that you have to have in order to get the business started. You need to have, for instance, there's an office lease of $1,000 a month. Um, and that is going to be there whether you're making a profit or not. And so it's just an example of showing how those sales are going to be against the expenses. And it's realistic. It is showing a investor and yourself exactly what you're up against. And then that income is a projection over the first year. So in the first year, in this particular example, they're expected to lose $17,473. So it's not, but they're building, you can see in the income that they are building on a kind of slow growth trajectory, 1,000 more widgets or whatever they are, 1,000 more of something every month. So it's a sustained growth, and by the end of the year, they are making $1,800 a month. And you can expect that in the next expense. I don't think I have an example of the next year of this same thing, but then you would have maybe the second year you'd say quarter 1, 2, 3, 4, and then you'd go into a annual comparison of growth. So you would say year 1 and show the 17,000 loss, year 2 at whatever growth you've got, 3, 4, and 5 at whatever growth you're expecting to have. Here's another example of an expense report. This one is showing the startup and expansion expenses before any widgets are even sold. And this is an important piece of the puzzle because it is showing some realistic costs that's going to, one, put you in debt to before you even start selling anything. It could be, in this case, it's land, it's buildings, it's machinery, it's inventory, property improvements. So they've got $1.3 million in expenses and a loan of $800,000. So that's interesting to show just what they're going to be in debt for, just to start off with. So, and then that first year, that second column over there is kind of the expenses that they've thinking that they're going to have also in that first year. So there's a startup expenses, and then there's the first year's expenses. One of the other financial documents that you're going to need to include is a balance sheet. A balance sheet is a point in time reflection as to how the business is doing. And it's divided into 3 different sections: assets, liabilities, and shareholders' equity. The assets have to balance and match the combination of liabilities and shareholders' equity. So all the assets that you own had to be paid for somehow. And so those then are going to be reflected under liabilities, the debt that you have, or the shareholders share their investments in the company. So this will be done on a quarterly basis and an annual basis. In this particular one, it's showing on an annual basis. So you might want to do it at the just for your um, sake of financial planning on a monthly basis at the end of each month. But you'll be showing this to investors on a quarterly or annual basis. So the last piece that you want to include, the last financial statement you want to include is a statement of cash flows. You want to show how you're going to pay your bills. And in this case, this example, it's on a monthly breakup, which is the first year. After that, you'll do years 2, 3, 4, and 5. And it shows the investor and yourself how you're going to, like I said, how you're going to pay your bills and where the cash is coming from. In this case, it's showing that there is 516, almost $100,000 in operating activities. Nothing from investing activities. I mean, they didn't sell or purchase any assets, but they did get $20 million in investments from an investment fund and a venture capitalist. So all of that put together, they have $20,665,000 odd in the bank. And then they have an operating loss. Then they have another, so it's showing as it progresses through time, through month to month, how they're going to have the cash to pay for their inventory, to pay for their employees, and all of that. It's important for the investor to know that you've got some cash on hand to do the things that it takes to run your business. And this will all go into this kind of information all flows into your balance sheet as well. There is some examples of cash flows and building a cash flow, statement of cash flows in the links that are on the site. The very last piece of the puzzle in your business plan is the appendices or appendix. This is where you're going to include a lot of the backup to what you've talked about in the sections that we've already discussed. So let's talk about what you could include in the appendices. You should include your credit history. Investors are going to want to know what your personal credit history is. If you've owned a business in the past, that you are going to pay your bills on time and that you are responsible to those creditors. You'll want to include the resumes of all the people that you've included up in that company management section. You want to include the partners' resumes, anybody that you've mentioned in that particular section. You want to include their resumes here so that they can see for themselves that those people have the skills, the ability, and the knowledge to do the job you've said they're going to do. Pictures are always good. If you have pictures of the product, then that way they can get an idea, a better idea about what they are and visualizing. Your letters of reference from people that you've worked with, the suppliers that you've worked with in the past at different businesses, or other types of references that will help your cause as you're trying to get money. Any kind of research that you've done included here. Any kind of references to the industry, magazine articles, internet articles, that sort of thing that will talk about the growth of the industry or of the product or that sort of thing. Or if you, for instance, have created the product and there's been an article about it, or if you want to be a consultant and go into business for yourself and there's been some articles about you, that would be awesome to include. Any kind of licenses, permits, certainly patents that you have, those things can help your cause as well. Any legal documents that you have, if you've already signed a lease, you might want to include that. Any contracts that you have, that sort of thing. If you're buying your own business, or buying an existing business, you might want to include any kinds of contracts or leases that you have that you will be absorbing into your business. Look, leases and contracts. Maps of locations, and that would include highlighting where the competitors are and the traffic flow and that sort of thing. You want to be able to let the reader visualize what they are buying into, really, and get a better understanding of it. If you have building permits, zoning permits, that sort of thing, that would be great. And then you'll want to list any of your consultants or any of those professionals that you're bringing on board to help you, including an attorney. Maybe there's a intellectual property attorney that you want to include, or an accountant or a bookkeeper and that sort of thing. So that ends the business plan. In this appendix, you'll want to include, as I said, anything that's going to help your cause, and that you don't want to include it all in the sections above so that they can just refer to them in the back. And then what we didn't include at the very beginning is this table of contents, and so you can include all of these items from the appendices in your table of contents so that they know they're there and how they're going to find them. Again, there's a bunch of links on the site, so feel free to dig deeper, especially into this financial section. So best of luck. There is a quiz and a outline that I want you to do and to send in by the midnight on the second Sunday. So I look forward to reading those and seeing what your plans are. Best of luck. It's been great to spend the last couple weeks with you. Thanks.